Welcome, everyone, to our Straddles and Strangles webcast. I'm Connie Hill. Happy that you joined me here today. You know, this is a class where we've just really focused on two strategies. However, changes are coming. Yep, some changes are coming that I need to make you aware of, which today will be our official last Straddles and Strangles webcast in this time slot. All right, so what's going to happen? We have a new course that's going to be rolled out in 2 weeks. Now, next Monday is Memorial Day, so we won't be meeting. The week after that will be June 1st, and we will have a new class hosted by somebody that's in our chat right now, Mr. Ben Watson, called Basics to Cryptocurrency. I know a lot of you have been excited to want to learn this kind of information, so we are starting a class on it. So instead of this class taking place, it will be cryptocurrency basics. And then this particular class, Straddles and Strangles, we're going to incorporate into a class that we actually had it in several months ago called Advanced Options. Right now it's called Condors, butterflies, and calendars, I think. And so we're going to be adding in straddles and strangles into that webcast as far as where you can be able to find out about how you can trade those as well. All right, so a little bit of change going on here. Now, I did mention Ben Watson's name. He's in the chat helping us out here today. As you have questions, go ahead, chat them in, and I'll keep my eye on the chat. Ben will as well. And we want you to get your questions answered. If you're listening to this on the recording, and I know lots of you do, what you want to do is type your questions into the comment section. I go back and review those throughout the day so that you get your questions answered quickly as well. Very good. Well, tell you what, let's go through some disclosures and let's get down to business. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for general and informational purposes and educational. Don't consider it a recommendation. We'll be using the Paper Money software application. Fantastic learning tool, fantastic to use as you're trying to maybe try out strategies, try out different rules, things of that nature. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount an option might be. This is something that's handled a little differently in Paper Money than in a live account. In Paper Money, it won't assign you early, but you have to know you could possibly be assigned early in a live account. Investing involves risk, including the loss of principal. Past performance is no guarantee of future results. All right. Oops, today we're going to take a look at the market conditions. We're going to talk a little bit, before we do that, a little bit about some advanced option strategies. And then in our class, we're going to go see what happened to our couple of trades from last week. We actually had 3 trades we're going to look at. And then we're going to introduce a couple of new ones. And I'm hoping what I can do is to follow up on those in some of my other classes. Okay, the ones that we put on here today. So advanced option strategies, there are a lot of them. Okay, so when we transition straddles and strangles back in to the advanced options class, these are some of the option strategies that might also be covered. Okay, and so I mentioned to you right now, butterflies, iron condors, and calendars are the main trades there, but we can get into ratio spreads, which is really fun. Here's our straddle strangle swap, which we have spent some time working on in this class. And so just know it's going to be maybe a little bit more variety in that particular class. It's not going to be just straddles and strangles, but you're going to get exposure to all of these different option strategies, which I really think it's a fantastic class. To be able to say, hey, this is a situation, which of all these strategies might we consider using on a particular situation, not necessarily just focused on earnings announcements or big news. Okay, let's head over to the Thinkorswim platform. Just kind of see where the market still might be. It looks like we're still down maybe a little bit on the SPX, down, what is that, about 0.24%, so not a ton. Let's check on our NASDAQ. I know it was down a little bit earlier. Let's see if it still is. It looks like it is down maybe, is that a 0.55%, so maybe about a 0.5%. So it's pulled back a little bit more. Look at our Russell 2000, our small cap stocks. It's down as well, down about 0.33%. So looks like we're pulling back a little bit, but not incredibly so. Not like a giant sell-off, at least at this point in the day. Our volatility index, if our markets are down a little bit, we would expect our VIX to be doing what? We would expect our VIX to maybe be a little bit elevated. And it looks like it's up a little bit here as well, 0.21, which is not a huge deal. But yes, it is doing the opposite of what the markets are doing, which is what we would expect out of the volatility index. Next up, let's take a look at what we did last week. A lot of our class, I think it's important that we spend time digesting the trades, talking about how we manage those trades, because it's pretty quick and easy to go ahead and put on some new trades. But the analysis of what we actually did and the decisions that we made and when we made those decisions, I think are really helpful to you guys. So first one we're going to talk about that we did last week was HIMS, HIMS. Oh, let me get my S in there. There we go. Last week we talked about this because they were having an earnings announcement coming up and knowing that maybe we might want to do a straddle or a strangle on this particular stock. Now, the formula or the script that I gave you that some of you might want to use is called this market maker move. For those of you that are listening to this on the recording, here it is, right sitting here on front, because I put it in a text box. For those of you that are in the class live right now, I'm going to copy that very same script over to you so that you can use it, do a copy and paste with it if you'd like to. Remember, anytime we share scripts, they're not guaranteed as to timing or accuracy, but you will find they can be very helpful. So in this case, that's what we did. They had the big earnings coming out, and that was on Monday night. So in our class, we got in here, all right? For straddles and strangles, they're speculative in nature. We're doing them because we think there's going to be a big move on the stock. Most of the time in this class, we've been doing it because of earnings, but you could do it for other situations as well. You could do it if the company is maybe due to make a big announcement. You know, a lawsuit's been filed and they're going to tell us what the result of the lawsuit is a situation. Somebody might consider doing a straddle or a strangle. Also, maybe it's an FDA approval that a stock is waiting for. And we're all kind of waiting there together. What's the FDA going to say? Are they going to say, oh, this phase 3 went really well, or it didn't, whatever they might say. And so maybe you're long a position, say you own the stock, then you might consider doing a straddle or strangle to protect yourself in the event that whatever the news is released, whatever that big move might be, that if it goes against you, you've got that option there to help offset it. So there's a lot of different places where we might consider doing the straddles and strangles. Now, in our class last week, we did both a straddle and a strangle on this stock. Normally, you don't necessarily do that. Okay, the only reason we did it in our class was so we could compare the results to each other. Okay, so we were going to do a little comparison there. So we did a straddle and a strangle, but we're long. When we're long, it means we're buying a call, buying a put of the same strike price that's at the money. Okay, that's our straddle. Our strangle is when we go a little bit out of the money instead. And so we go a little bit out of the money on a put, a little bit out of the money on the call. Overall, our net debit typically is going to be a little bit less since we're buying options that are out of the money. But our break-even points, they get stretched out a little bit depending on how far out of the money that we decided to go. Okay. So we can see here, that's when we got in. And the next day, what happened with the announcement? What happened with these guys? They definitely dropped. Okay. We can see the close here was 25.03. The opening price the next day after the earnings announcement was out, and the market could start reacting to it. The opening price here was 25.21. 25.21 from a closing price of Let me find my C again, 29. So that was a pretty good sized drop, right? On that one. So what happened with our trades? Well, number one, when we were doing these trades and putting them on, let's just go to we're going to go to our account statement here. Here we put on our straddle and we did a 30 call and a 30 put, and we had a net debit of that of 587. Okay. There was a lot of implied volatility priced into those options. If I go back and look at my notes, it was about 16.35%, which was huge. Where did that come from? So the market maker move, when we were back on the charts looking at it, that market maker move, right now it's significantly lower, but at that time it was 16.35%, which is huge, meaning there was a lot of implied volatility priced into those options. Means there was an expectation of a really big move, and it gave it to us. It gave us a really big move. So let's go back here and I'll show you what we did. The strangle is only partially correct here. Okay. We did an out of the money put of 29, and I didn't really catch my mistake until the next day that I grabbed a 30 call to go on the other side of this. Technically, what we really would have wanted to have done is a little bit one strike out of the money to match the 29 put. We should have done a 31 call here. Okay. However, that didn't happen because I didn't notice the mistake. We're still going to track how these went, but it's not going to give us an absolutely true picture because it's not an absolute strangle, okay, in that scenario. Just one of the strikes was out of the money. In any case, what happened? So when the stock dropped, we could tell pretty quickly that our put was the one that was going to be the one we'd be holding on to. Our call was not going to do us a whole lot. And so the next morning, well, they announced, and then the stock dropped in after hours. And then in the morning, it dropped again a little bit more. So when it opened up, that was really a big gap there. So you can see my timestamp here on the 12th is 7:31, which in the mountain time zone where I am, market opens at 7:30. So at 7:31, options start trading. And so we sold both of those calls because they weren't doing us any good. And one of them was from the strangle and one of them was from the straddle. Okay. Next up, we held on to our puts. So we had a 30 put here and a 29 put. And this side of the trade is totally accurate. Okay. And so let's kind of see what happened. I'm going to show you the chart and then we'll come back to look at the numbers here. And what we're going to do is we're going to go to a 5-day, 5-minute chart. We're going to come back here. We're going to look at this and we're going to say, all right, the earnings announcement happened here, which was after the market had closed on Monday. And we can see what the reaction was. Just the gray area rather is our after earnings or our after market and our before market time frame. So we can see the news came out, they dropped, they continued to drop, and then they kind of went sideways for the rest of the after hours. Now I'm going to come and zoom in on this area of the chart, okay? Because this is where some decisions were made. So it started trading. This will be Tuesday morning. Let me make sure I'm on the right day, the 12th. And so we got out that very first minute. Okay, we got rid of those calls that weren't going to do us any good, just see what we could get out of them. Okay, so the very first candle looked like it was starting to pop up a little bit, but remember it had already dropped in our pre-market. Okay, so it was already down there quite a ways. Then it wasn't until a couple of days later that we actually sold our puts. We held on to this trade. We traded through the 12th, the 13th, and then we got out on the 14th in the morning. Okay, so if we go back to the chart here real quickly, let's just do a 3-month chart so you can kind of get some context here. So we didn't get out this day, we stayed in, it went even lower the next day, but then on the 14th, this day, that's when we actually got out because it looked like it was maybe going to start to recover, that the drop was over. Okay, so that's when we decided, fine, we'll get out, we'll see how much money we made on this. Okay. Let me just look at something here. Just seeing what the questions were. Are you closing at market or are you setting a price? Is the question here. Are you closing at market or are you setting a price? We'll go on the Analyze tab, or not that, on the account statement, and I'll show you. I put in my order here. They actually were limit prices. We can see there were a few more orders that went in than were actually executed, and some of them I had to go out and cancel. So like initially we had, it looks like we put in here, we were looking, hey, if we can put in a stop here to get out at maybe 50% of what the spread was worth. If we needed to, we could get out. Those ended up being canceled. The ones that ended up being filled are going to be right up here. This we put in for 520, and it looks like it filled us for instead of 520, 545, gave us a little bit nicer price. This one we said let's fill it at 480, and it gave us a little bit nicer price here as well. Gave us 670. Okay. Now, as I went through, added up the numbers, turns out we were positive on both trades, but they were different in terms of what happened. Actually, let me leave this trade history open here. So I went through on the straddle, and I took our net debit of 587 and I subtracted out on the straddle. That one we had 83 cents is what we sold that call for. So that helped lower our net debit then. And then we ended up getting out of the trade at 670. And so the gain on the trade for our one contract was $166. So not an incredible celebration type of trade. It's just kind of a basic base hit is what it ended up being. But we were able to play it out for several days, which was nice to be able to do. Sometimes we haven't been able to do it. It's been a make a decision pretty quickly after the news is out and vacate the trade. Okay. The strangle, and I'm going to say our inaccurate strangle because only the 29 put was the side of that was exactly what we would want in a strangle. It ended up being a little bit less profitable. On it, we were able to garner, we took our 531, this initial net debit here, added back in or subtracted the 63, the call that we sold. That's how much we brought back in so we could lower our net debit a little bit there. And then we ended up selling it for 545. And so the math on that works out to not be a whole bunch, but it works out to be about $77. Now I took what we got out of the trade, what the profit was, and I divided it by each net debit. So the net debit here, 587, when I said, hey, let's go look at our 166, that gave us a return of about 31%. Okay, so 31 is like, it's okay, kind of like a base hit type of thing. Although I would say sometimes we'll do verticals. And on short verticals, a lot of people are happy if they get a 30+% return, but usually it takes it several days to actually get there, right? In this case, we were in the trade for 3 days and then we were out. On the strangle, it ended up being a percent gain of about 14%. Okay, so again, a little bit not exactly a strangle, but the break even spread out a little bit. Yes, we still made money on the trade, but it was only about 14%. All right, let's make sure we get these questions answered that we have here. Jerry says, hey, I joined late. No problem, Jerry. When is a straddle or a strangle an appropriate trade? So when you might think of doing one is when you think, man, the stock has got to move big. We'll talk about why it's got to move big, okay, where our expectation is big. Like sometimes some of these earnings announcements, and we've done several of them, where they're kind of like some of the news of the week, right? As we go through earnings, some of them are like, yep, we really want to see what's going to go on with this stock. And we look and see how much implied volatility has been priced in. And if it looks like historically there have been big moves, and we see that right now the market is putting in a lot of implied volatility, it's pricing a lot into the option price. That's because the market is expecting a big move. And so you do these, they're again speculative in nature. I wouldn't expect anybody to have this be your bread and butter strategy. Okay. There are a lot of other strategies that are higher probability. These are kind of lower probability strategies, but we still could possibly make a decent profit on it. Okay. We made, I'm going to say, a decent profit off the straddle on HIMS, on HIMS. Okay. So that's when we're considering doing it, when there's a big move expected. Could be FDA announcement, could be news of the corporation, or like an earnings announcement. Okay. So, okay, I think we got those questions answered there. All right, so that was our HIMS trade. There was quite a bit going on with this one. The other trade that we did was on, let's go to the chart here first. Oh, actually, I was going to show you. Let me finish. Yeah, let's jump over. Let's go to Mara. I was going to show you what the candle looked like when we got out of the second one, but basically the stock looked like it was stabilizing. It wasn't going to pull back anymore. So that's when we decided to get out. Okay, Mara. They announced their earnings on, let's see, the date here is the 11th. So they were also on Monday after the market closed. Okay, so again, Tuesday morning is when we were able to see what was going on with it. Now I'm going to go ahead and I'm going to kind of zoom in here a little bit. And you're going to notice I've got like this little arrow. And this little arrow is going to point to when we actually got out of the trade on this one. So it was bullish the night before, right? Green candle. They announced their earnings. Next morning it reacts. And what did it have? It had a gap down, didn't it? Because it closed at 1339 and it opened at 1291. Okay, so a little bit of a gap down, dropped, and then by the end of the day, kind of came back here. So if we were looking at this, just this singular candle pattern, we might call it, say it's hammerish looking. The head is fairly small, but the body here down at the bottom is at least twice as long as the width of the body. And so we'd call that a hammer candle, which means potential reversal as well. Okay, now let's go into our 5-day, 5-minute chart. We ended up getting out of this the same day. So notice this, they announced here Monday night and it dropped in that post market. You can see that big drop, and then it kind of stayed stable after the big drop. And then the next morning, what did it do? Dropped some more. Now see this little arrow here? This is when we actually got out. So I'm going to just maybe zoom in on this much of the chart. Okay. So next morning it drops, and then it kind of stays steady, and we're looking, hey, is it going to recover a little bit or is it going to pull back? In this case, it continued to recover, and then it kind of stayed flat for a few days. And so on this very candle that I'm pointing to here, it's kind of small and green. That's really the candle that we got out on. Okay, so we had seen it drop. We'd seen a little bit of recovery and looked like it was going to drop a lot more. Okay, so that's what we saw on it. Now let's go to our account statement here. And on this one, we did a long strangle. We bought the 14 call and the 13 put. Both of these stocks were a little bit lower priced, which gave us a 147 net debit. And you can see we could take these numbers and add them up here real quick. We just barely made some money on this one. Okay, the move was just not huge and it didn't stick. If we had gotten out at its peak drop point, that would have been wonderful. We don't know when that's going to be, right? we have to kind of wait for history to happen so we can see, gee, did we make a good decision there or not a good decision? We could have been more profitable if we got out, just as soon as it started popping up, but we don't know that. Okay, which is why we kind of waited for it. It did come up a little bit. It started to stabilize, looked like it was going to drop again. That's when we decided to get out. So mathematicians here, take your 147, subtract 39 from it, then subtract 111 from it. And we ended up having a little bit of a gain. And I don't think I ran the numbers on that here. Let's go run them real quick. $1.47 minus 0.39 minus 111. So yeah, it was almost like a break-even-ish trade. So $3. Not a whole lot on that one. Let's see here. Lakshmi said a stock has a reverse split. And when it has a reverse split, you do not, you avoid it like the plague if you see a reverse split. Does this have a reverse split on it, Mara? Maybe that's just some commentary. I don't think either of these had any splits sitting out there. Now, not any splits sitting out here from this one. And HIMS, it's actually been flying high for a while. So yeah, no stock splits that we're seeing here. I don't think it had it. A split was had on either one of these stocks. All right. Looking at Jerry's comment here, hopefully we got that answer between Ben and myself about looking for big moves. When might we expect a big move? All right. Well, who do you think is the big earnings that people are going to have their eye on this week? And any ticker symbols come to mind? Any of the biggest semiconductor type stocks come to mind? Yeah, all eyes are going to be on NVIDIA this week, right? Let's go pull them up. And recently, actually, NVIDIA hasn't had huge moves. I went back, looked at the whole year. The first two were actually smaller moves. Last year, it was making enormous moves. It really was. But more recently, not so much. The most recent earnings announcement, it did move pretty decent, okay? We can see it closed here at 195 and some change. And then the next day it opened at 194. So a little bit of a move there from 195 to 194 and change, but then it dropped the whole day. And so to judge if it makes big movements over earnings, we're looking for either gaps or big candles. In this case, it had a big candle, dropped down and continued to drop the rest of the day, gap down the next day, continued to drop. So it had two pretty big days here. I'm going to use the measuring stick here. I'm going to go to actually, let me zoom in a little bit here. This will make it hopefully a little bit more accurate. I'm going to measure what the move was. So I'm going from roughly the closing price. And at the end of the next day, that looks like that was down in the neighborhood of about 6%. The next day when it dropped and where it closed here, looks like about 9.72%. So over the course of a couple of days, it did make a pretty good size move, okay? But all eyes are on it. I saw some upgrades this morning. A couple of brokers had changed price target to go higher on NVIDIA, those came in today. So there's kind of a lot expected. Those of you that chatted in NVIDIA, yes, big eyes are going to be on it. Lakshmi said maybe Avgo. Is Avgo announcing? Broadcom, I thought they had already announced. Looks like the last time they announced was in March 4th, so April, May, June. So they might not announce until June on Broadcom there. Okay, let's get back to NVIDIA. All right, so of these trades, it's interesting, the market maker move is not showing up yet. What is the market maker move? That's the implied volatility priced into the at-the-money options during the series when they are going to expire. Okay, well, if they don't announce until, I think this is, let's see if that's Wednesday or Thursday. The 20th is Wednesday. So at night after the market closes on Wednesday, that's when they will announce Thursday morning is going to be our first opportunity with the whole market engaged to see how things react. Okay, so we'll be in it for a few days before something happens. Now, many times implied volatility will ramp up prior to an earnings announcement. I'm going to add implied volatility so we can see if it's happening here. Implied volatility, let's add that in and let's kind of move it up here. And let's make it a little bit, oh, it's coming in at a 5. All right, good. Should come in nice and thick for us. Where did it go? It's in with the volume. We don't want it in with the volume. Let's do this. Let's move it down here. Let's make this good that way. We've got our volume. Let's just see if I change it here. Kind of always want my volume on the bottom. I'm a little OCD about it. It does not want to do it. Okay, we're going to have to deal with the volume being there. Okay, there's our volume. There we go. All right, here's our implied volatility. Now it's on the screen. I guess I lost our MACD. All right, so it has been ramping up here, right? It's working into earnings. So the implied volatility that's being priced into it keeps growing a little bit, which means, well, today it's down a little bit. So are those options going to be expensive? Well, usually the market maker move shows you that. That's the script that I shared with you that is right here, that we could see what the market maker move was. Now on this one, for whatever reason, I don't know why it's not showing up. I expect it's going to come on during the week. Okay. So NVIDIA has those many weekly possibilities. They have Monday, Wednesday, and Friday options. Some of these are relatively new. It was about a couple of months ago that the Mag 7 and Broadcom were given additional expiration dates because they are just so widely traded. And so we have to say, oh, well, which of these is going to be when they expire? Well, if earnings is on the 20th, then it's going to be the ones here. So we've got some that are going to expire today. And 22 actually is on Friday. I'm not sure where, usually this has a Wednesday in there. I'm not sure where the Wednesday option is on this one. Maybe they didn't create it. I don't know. All right, but this is when it will actually expire. So if we look at the implied volatility that's priced in to those options, it looks like about 85%. Okay, so there are the options that are going to expire today. What's priced in those? About 74%. So 85% here, and then next week after that, it pulls out to 65%. And that would be on the 26th expiring, which is going to be next Tuesday. Now, why Tuesday? We were talking about Monday, Wednesday, Friday. Next Monday is going to be Memorial Day. The market's going to be closed. So because they could not have it expire on Monday because the market's not going to be in action, they moved it to Tuesday. Okay. And so that's why we have a Tuesday, and then we have a Wednesday, and then we have a Friday next week. But because of where the earnings is going to be released this week, the one that we would notice is this 85% one here. And if we take the at the money option on both of these, right now it's at 222. Earlier it was at 225. So let's say 222.50 is going to be our at the money. Then our straddle price here is going to be, we'll select on the put there. I'm going to hold down my control key so that we have our call and our put there. So our at the money straddle is about $15.58. Okay, that will be fairly close to this number out here. And if we had that market maker move, which really would be sitting up there by my green arrow, it would probably reflect something in this neighborhood of about 1560. Okay, as far as what is the market maker move. So the market would expect the stock to move either up or down $15.60. Do we know which way? No, we all got to find out together. Market all reacts at the same time to that news coming out. Now, if somebody said, maybe I want to go short a straddle, right? Rather than buying these, they said, I want to sell that implied volatility. That would be a short straddle. Instead of buying the call and the put, we would be selling the call and the put. Okay. Now, some people might say, I don't know that I want to do that. Yeah, I can see there's a lot of implied volatility there. What we have found when we have done short straddles, if the move is really big and even bigger than what we expected it to be, we have to go buy back the short losing option. And sometimes it puts us at a really big disadvantage. And then the other leg has to kind of make up for it. Okay. So we're not going to do a short straddle strangle here. In fact, what we're going to do is we're not even going to use this week. We're going to go out and we're going to give ourselves a little bit of time if the stock kind of needs it. What we've been noticing is sometimes it'll make a big move for the first day and sometimes the second day, and then sometimes it'll just kind of reverse course. That's what we saw on HIMSS. That's what we saw on Mara, right? That they made that initial move and then it kind of goes the opposite way. So if we want a little bit of extra time, we want to buy it. So we're not going to buy the most expensive options here. We're going to go out. We could come out to the 26th or the 27th, or we can even come out to the 29th, which would be a couple of weeks from now. Okay. Let's go look at liquidity here. Let's come out to the 29th first. Now I show my open interest here in the options chain. So are we seeing a lot of activity here? Yeah, we're seeing thousands of contracts and thousands of contracts, a lot more on the call side than the put side. So maybe people are a little bit more bullish. Hard to know exactly, right? But we're seeing lots of open interest and our spreads are pretty tight, right? 745 by 755, a 10-cent spread. Oh, we love seeing this type of thing. So we're going to go out 11 days. We probably don't need a lot more than 11 days. So we're just going to go out those 11 days, which will be next week on Friday when those expire. And we're going to do an at the money straddle here. Okay. So we are going to go 222. Now it's at 223. That's still our at the money. Well, let's see, Yeah, this is still going to be our at the money strike price. So we're going to do this. We are going to buy the call. We're going to buy the put. The price has been, the 222.50 price has been adjusting here a little bit. If you wanted to do multiple, if your position sizing would allow you to buy more contracts, you could. And you could say, maybe we'll take action at selling the first contract when we know the initial reaction, and maybe hold on to the other leg if we think we could get a little bit more mileage out of it. If we think the stock, so maybe say the news is negative. I don't know what it's going to be, but suppose the news is negative and it has an initial gap down. We might sell one leg and then we might hold the other leg and say, okay, is the other one maybe going to drop a little bit more? We can get a little bit more profit out of it because we think the stock maybe is going to continue to drop. And the reverse could be true. Pop, and maybe it'll pop a little bit more. Okay, so that's why oh my goodness, what is it doing? It got stuck there. No, we don't want 170 contracts there. Let me just kind of delete that whole thing. We're just going to do 2. There we go. All right, I think my mouse got stuck on it. So that's what we're going to do on NVIDIA. Now, come a couple of weeks when you're in the class where Brent is talking about all those strategies, all those advanced strategies, including straddles and strangles, he may incorporate a straddle or strangle here and there, or he may incorporate maybe a different trade that he thinks maybe is more appropriate for that earnings announcement. Okay. But in our class, we've just been doing straddles and strangles, and that's it. So let's go ahead. We're going to send this one in. We're going to do those 2 contracts. We're going to put it in our straddles and strangles bucket. Now, a request I've had from some of you that came in via a survey, it also came in some comments, was maybe looking at a short straddle or a short strangle. Generally speaking, in this class, when we go short on it, we've been doing the straddle. We've been wanting to bring in more premium, which is going to be at our straddle versus our strangle. Now, there are some stocks that maybe have been moving a little bit sideways that we could consider for this. So for example, let's go out here, Nike. Nike's been pretty sideways. They aren't going through an earnings period, but they do have a little bit that's showing a market maker move here of 2%, but we can see it's just been kind of sideways. And so that might be a stock that to consider doing a short straddle on, is maybe something that is not incredibly volatile, that we expect maybe just small movement. So maybe we can sell the call, we can sell the put and just let it decay. Okay, so hop on over with me to the trade tab. And with the stock at 42 on Nike, that's going to be our at the money. So if we were interested in selling, and again, we could choose any time that we most want. Okay, I kind of like this, just the May 29th, the next Friday's options expiration, so that we can get that fast, hopefully that fast time decay. We're going to sell the 42 call and the 42 put. I'm going to hold down my control key to do that. And that says that we'll be bringing in a credit of 213. Now, what's the risk on this trade? The risk is having the naked options. Being short a put just means we're willing to accept ownership of the stock at $42. However, the naked call means we have to deliver it to somebody else for $42. And theoretically, maybe some big news could come in. Maybe some giant somebody buys Nike and says, we're going to just take you over. We're going to put in this bid, and the stock gaps up. Now, I don't know who's bigger than Nike in the shoe business, but it's just theoretical discussion, right? And say the stock pops up, man, it could continue to go, which is why we have unlimited risk potential there. And so what sometimes people have done is they've gone out even further out of the money and bought some protection. And on that protection, usually they're doing a long strangle. Okay, it doesn't have to be any particular length of time. It's just that they want to be covered. So if we were doing, say, the May 29th, we might just go out to, say, the June 5s to buy that strangle that would give us that protection. Now, do you have to buy both the call and the put? You don't. If you if you're okay taking ownership of Nike at $42, you might not even bother buying a little bit of protection there. But on the call, more likely than not, you'd want to protect. Okay, we'll go ahead, we'll buy both legs here. Let's go out here to June 5th. And we're going to go a little bit out of the money here on our protection. And oh, interesting, it has 41.50 strike price here. So it has a little bit closer dimensions than what we had on the others. So let's go out to 41.50 on the put. And let's go out to, out of the money here is going to be more like 43. We'll go out 43 here. And what happened here? That turned it, okay, so by adding them on together, it'll put it through as a double diagonal. Looks like with those credits, because where the implied volatility is, it's a pretty flat trade right now, right, with a 5-cent debit. We're going to go ahead, we'll put this in. If I have a chance to follow up on it in one of my other classes, I will do so. But those of you that wanted to talk about short strangles and straddles, the big thing there is having that protection in place, especially on that naked call, okay? So you don't have that unlimited risk potential, and that you're not tying up as much margin as well. That's the reason to have the protections in there. All right. So June 5 is going to be for the straddle, for our protection. And then for the ones that we sold, it's going to be these May 29s that we can see down here. Okay, let's go ahead and let's send that in. And we'll put it in our bucket here for straddles and strangles. There is another earnings announcement if you wanted to practice straddle strangles that might be coming up this week. this will be the last one I mentioned, is going to be Walmart. They're going to be coming up on, I think, Thursday as well. That's the 21st. So they're going to announce before the market opens. So if you wanted to get in another practice trade, Walmart might be something else. You can see what the market maker move is there, 4.53%. All right, you guys, I hope you're subscribers to our Trader Talks channel. That's where you find our content. It's where we make it easy to find our content, right? You can see what's going on. Coming up next, we're going to have Trading a Smaller Account with Barb Armstrong. I know lots of you love that class. You can see the agenda the rest of the day. Notice here, Ben's going to help host with Lizanne live later, and then he will be teaching the Investing in ETFs class. You got to be there live to catch that, okay? Ben and I would love a follow from you on X, Ben Watson CS, Connie Hill CS. Appreciate all of you being here today. Ben, thank you for helping out in the chat. Appreciate you helping me cover some of those questions. So have a great day, everyone. We'll see you back here at the top of the hour for Trading a Smaller Account. If this was helpful to you, go ahead and hit the like button on your way out as well. We'll see you soon. Bye-bye.